Hello, YouTube. Today we're going to talk about there is one simple pattern to watch, the one we talked about on the weekend, in terms of how there could still be a bear trap being set up. And yes, I understand that now in hindsight, that thumbnail and the video might seem like there needs to be an explanation in terms of what happened and whether or not we need to change our tune. As a reminder, I am a human being. I am not 100% accurate. What we look for is probability, and we also look for what is going to provide the highest risk reward. So that is exactly what we're going to talk about today because there are some changing dynamics and some new data for us to go through. So let's jump straight in. As we're getting started here, I'm going to ask you for a favor. If you could please smash that thumbs up, that would be greatly appreciated. So right now we're talking about the one pattern to watch. We're talking about the monthly chart. We're talking about a bounce off the 50 monthly, and then we're looking for the 2 green month pattern. So there are a few times this has happened going back to, where are we now? Going back to roughly 2018, but even before. We want to focus on these last couple of periods here. We're going to talk about 2018 and this test right here on the 50 monthly moving average. And then we're also going to talk about the last test here in 2020. So first of all, let's understand whether or not this is similar. Yes, it is. So back in 2018, we didn't have two back-to-back red months, but we come back down, bounce off the 50 monthly, and then we put in 1, 2, 3, 4 green months. So we bounce off the 50 and then we form those 2 green months. Check. That's what happened in 2018. Looking at 2020, same thing. 1, 2, 3 red months, bounce off the 50 monthly. Then we got 1, 2, 3, 4, 5 here. It ultimately expands more. I'm not sure we're going to just expand to infinity like in 2020, but what we're looking at here is where we expect to find buyers and what happens after we test this area, because we blew through weekly lows. So the monthly chart is really the last one to look at. And if we understand the story now, all right. If you want more details, there will also be the weekend deep dive pinned in the top comment and also in the description. All right, let's look. So we're looking at this month right here specifically, the third month. And then in 2020, we're looking at this month right here, the third month. And specifically, whether or not we lose the high from our first green month off the 50 monthly. So back in 2019 here, we have a high of 270.47. And on our low in our third month, 272.42. All right. So this one over here, that's a pass. This one right here passed the pattern. It ultimately went sideways to up. And that was a long time. This is January of 2019 to January of 2020. That's 12 months. And now if we look at the next period here, it's 2020. All right. So we got our 1, 2. We're looking at our third candle here. We're now going to look at the high from April 20th month, and that's going to be 29488. The low from our pattern over here, 29674, which means we actually saved it by about 0.5%. 0.5% here, roughly 0.5% here, or a couple of points. So if now we look at where we are currently in 2022, let's look and see if there is a similarity. All right. So our high from October is 398.52. Our low so far here, 391.64. Oh, that's like really close, Justin. Is it going to hold? Yeah, that's the question. And I think that looking back in hindsight, we're going to say, of course, that was the buy, or of course, that was the sell. And what we're trying to answer is whether or not the third time is the charm. What fizzled in March, what fizzled in June is fizzling right now in October. But if we're able to maintain the previous highs, that is where this might be invalidated. Right here in April, we tried to bounce off the February high, March high, and then it failed. Back over here in June and July, that was the fail right here going into August. So if we're not going to hold, there's a very clear level. It's roughly 389. So if we print below 389, this pattern is no longer valid, period. Doesn't work anymore. And this is important because if we now have a look here at our weekly chart or how that monthly chart is formed, let's have a look at some key areas here. I'm going to put the magnet on. We're going to grab a horizontal ray. I'm going to snap it to the lows from the last 2 weeks. We got one here at 392.66. And then we also have one here at 393.3. And I was watching these areas all day. So actually, I'm going to step back for one moment to explain one more thing here. The reason why I was looking for a potential bear trap was because this area was vigorously defended into Wednesday and then also on Friday, talking about the 200 DMA. And ever since we got those Nikki leaks where the Wall Street Journal is saying that the Fed is going to lower the rate of increases to 50 basis points, but keep that terminal rate higher. And the last few times we've had those Nikki leaks, it's usually because the Fed is losing control on messaging and they want the market to go one way. So that's what makes sense to me right now. How could we have formed such strong support on this 200 DMA just to slice through it like butter the last 2 days? It didn't even look back. It's down dramatically so far this week. So if we understand that, and the second thing I would note is that the low of 393.48 is also the low from the Powell pump. So the Powell pump is right here at 393.48, and that's pretty much what we're closing out here at right now. So we're going to keep in mind of 392.66 and 393.3. Now let's look to a shorter time frame like the 15-minute, like we have before, because what this will tell you is just how important these areas are. So initially, going into about 1 o'clock today, we attempt to bounce off 393.3. That is where we would expect to find buyers. We cannot form a higher high, though, only into the third candle here. So what happens? Well, we close on 393.3. We push even all the way below 392.66. I would have expected to find more buyers in here. They didn't. So we go one leg down, two legs down, we go sideways, and then they just pump the close. So the question is this real? Is that really the low? Because the weekly level, the monthly level are both like super important here. And if we now have a look here at the monthly chart, we're going to look at two more things because there's a failed breakout on the weekly, and there's a failed breakdown failed breakout on the monthly, failed to break down on the weekly. What I'm talking about is we printed a new monthly higher high, but then we fell below, and that's here at 407.68. So the fact that we fell back below on a monthly time frame tells us that this is a failed monthly breakout as of now. However, it's only December 6th, and we got a higher high and a higher low. So is that enough to say the Santa rally is over and we're not going to go higher? Well, let's have a look here at the weekly, because I just told you that 390 basically cannot get printed. We have to save, 389. And now here on the weekly, what is this? Well, we have a lower low and a lower high. So that's not a bearish engulfing candle, but it's a bearish pattern. So if we've now poked below the 2 weeks low and we do not we don't hold them, meaning now we revisit and go back down and lose 390, that's going to be like really bad. That's going to mean we're probably going down to the lows at 360, if not lower, and it might have already started. So we're going to know that in hindsight. So if we now understand that if this is going to be a failed weekly breakout and that monthly area of a 389 like pretty much has to hold, we can't afford to really stall out here. It's what I also mentioned yesterday when we were looking at our 1-day chart and we snapped an uptrend on here. Let me actually just flip over to this board here where we already have it drawn. So we now note that like yesterday was like really important. Yep, and we failed to go higher, which means we broke our uptrend. So now we're not going up anymore. And if we hide all the lines, we now have 2 consecutive daily closes below the 200 DMA. So we spent 3 days above, 2 days below. We're definitely going sideways. And what I'm still not seeing for confirmation from the bears is a big fat sell bar. That might get deferred until next week when we have the Fed. This week is really all about positioning. And all we did was pump up on Powell and then dump on the Nikki leaks. That's the story for me. We hit the key resistance, going all the way back to our all-time high, which is where we would expect to find sellers. We found them. Buyers are a little bit harder to find. They're not showing up where we would expect to. And the reason might be because the Wall Street chorus grows louder, warning that 2023 will be ugly. We also note that Wall Street managers are learning to love Treasury bonds again. Highest Treasury coupons since the Great Financial Crisis provide appealing income. So is the third time still a charm? And even me, right? I'm getting really confused in here because the price action's choppy. We're getting failed breakouts. We're getting failed breakdowns. And I think this is all about positioning before we go into Jerome Powell and the FOMC next week, also with that CPI print. So just to look here at a few more charts because we want to try to understand what's happening. So we got a lower high and a lower low with a key rejection here on SPY on the weekly. And the onus is now on the bulls to defend the chart. Because if this is going to be a failed breakdown, we need to pretty much hold this area into Friday. I don't want to see any more weakness. None. I want to see it bought up. On the weekly here for QQQ, perfect rejection. We look back in hindsight. Yes, perfect rejection. And We've also lost a key area now, the 50% retracement, which is found at 286.62. So if the momentum is now to the downside, QQQ is like really close to its 200 weekly moving average. The low last week is at 279.17, and our 200 MA right now is at 278.31. So if QQQ also prints a lower low, it pretty much means that we're going to be below our 200 monthly, and now that is likely going to act as resistance. Our channel lower is being respected, and I don't know how we're going to overcome it unless the market is selling this off before we rally up into Powell. So that was really my thesis on the weekend. It was more about are we able to understand what a trap would look like for us to actually rally up into the end of the year? I'm not sure that's what the game plan is anymore. So as the plot thickens, there's two more things I want to look at here. I want to look at the dollar, I want to look at VIX, and then I want to look at treasuries really fast. So as we have a look here at the dollar, we're bouncing off the 50 weekly. And what happened on SPY? That's right. We talked about it on the weekend. We rejected basically off the 50 weekly. So if S&P remains below its 50 weekly and DXY remains above, this is what's adding the pressure, or at least part of it. We have to get back above 106.56 or our multi-decade head and shoulders for us to start going higher again, or mean stocks go back down. And if we fall back below 103.8, I'm thinking that maybe we're going to hold up, meaning the S&P is going to hold up. It means that we're going to be below our short-term top here at 103.8 and also below our 50 weekly. So DXY is probably going to be providing a lot of clues right now. Previous resistance is now turning into support. That's the telltale sign it wants to go higher. And if we have a look here at the VIX, it's still deeply depressed down here at 22, but this has also been an excellent predictor that every time we poke below 20 into 2022, it's been 4 times now, it's had a 100% hit ratio. So the third time's the charm. Well, we got to get back below 20. We got to break that VIX down, and we cannot afford to go higher because every time it's been an accurate predictor. Looking at the 2-year note, it's still strong, baby. It's up 2% on the week. And then looking here at the 10-year note, a lot less. It's up by 1.29. And to understand the inversion, fresh record high is 1.23. There's nothing to see here. So that inversion is not at a level we have seen since this chart was birthed. You can note the dinosaur back here, which is when this chart came online. But going back to the 1980s, roughly 1981, we have not seen a inversion any higher than about 1%. But it's usually like a 12-month leading indicator to when we actually have that collapse. So when we look here, we got July, when we actually penetrate 1. We penetrated 1 in March of 2022. So if we extrapolate that out, March of 2023 is when we would have the recession confirmed. When is that? That's Q1 of 23. So that's like when we're supposed to be starting the recession into next year if we haven't already started it. Q1 and Q2. So that's pretty much it. The lines are very obvious to me. Support and resistance is going to be either held or lost. And if you want to know more, I encourage you to watch the weekend deep dive, which is going to be here now. And otherwise, I wish you all the best of luck into the rest of the week. And thank you so much for watching. Thumbs up goes a really long way. And I look forward to seeing you tomorrow. Thank you.